Welcome to Big Money Monday on the Savvy Radio Show. Get ready, you are about to get paid. This show is designed to increase your financial intelligence every Monday.
What's going down, Savvy investors? This is your peep, Steve Van Kallenberg, the Savvy Landlord, and I haven't done a Big Money Monday in a minute, so we're going to drop one today. Hopefully this encourages you and go out there and go borrow some money. So the title is Choosing the Right Bank for Your Acquisitions. And I will get deeper. I'm actually writing a book on banking, and it's taking me longer than anticipated. But I have all this content that I just want to share from experience and mistakes that I've made. But you will get as much information as possible throughout the next couple of weeks or months or years. So let's just not fool around. Let's get down and dirty. First of all, let's break some myths about banks in general. Now, when I'm talking about banks, I'm talking about real estate friendly banks, not your giant Chase Manhattan bank down the street that's going to treat you like a number. I'm talking about a bank that kind of knows you and knows what you're doing. Myth number one, all banks are the same. This is something that I learned years ago that I thought, I was afraid of banks. They're white collar. I'm blue collar. I don't know the language. I'm not educated. I'm insecure, blah, blah, blah. And I thought all banks followed a specific system, audits or whatever. They have accounting principles, but every bank has its own rules of how they loan money. And just a real simple example is some banks only loan to people with a 700 credit score, and some banks will work with you if you've got a 650. So that's a myth right there that the policies and procedures are not all the same. Here's another myth about not banks all the same. I have a loan with a bank and it's on a balloon, which is due, say, 5-year balloon. And most banks will renew that, okay? And a lot of people get nervous about balloons, and there'll be another whole chapter. But when that balloon is due, okay, the banker should call you and say, hey, what do you want to do? Do you want to refinance out? Do you want to renew? Okay, refinance and renew are two different things. Are you going to pay your balloon payment? The cool thing is some real estate friendly banks, they are very small macro banks. You want you to renew that. And of course, you want to renew that. You want to keep the ball rolling. But what I found from another bank that they charged me a fee to renew that loan. Crazy. Another bank, they didn't charge me anything. So that's the point. Not all banks are the same. Everyone has a different policy and procedures. Each bank has their own CEO or board of directors or policies. So you've got to understand that not all banks are the same. And some banks are more fluid. Some banks are more flexible. So you got to figure it out. You like that stuff. Anyway, number two, another myth. What the loan officer says is golden. I used to think that whatever they said was the truth, or that's exactly how you need to do it. Not all loan officers are golden or what they say. For example, I just applied for a loan and they said, Mr. Van Kallenberg, we're just going to go off of your 2015 financials. Great. When I applied for this very large loan, we need current financials. But you just said, Mr. Banker, just 2 weeks ago that you were going to jump off my 2015 financials. And so not everything the loan officer says is golden. Another example is you should do your taxes this way, or you should have your financial statement this way, or you should categorize your P&Ls this way, profit and loss, okay? Again, not everything the loan or banker officer says is golden. Keep that in mind. You are the entrepreneur. You are the business owner. You are driving the vehicle. You are in control. Number three, all banks are slow. That's a myth. That is a lie. Not all banks are slow. I've done pretty large transactions in the tune of over 200,000 within 5 days, meaning I got the appraisal on Monday, they approved it, and then boom, on Friday I closed. Does it happen all the time? No. But the truth is, not all banks are slow. On an average, I would say commercial money is about 3 to 6 weeks. So when you are locking up a property that you're going to close, may it be $100,000, $50,000, or a $500,000 acquisition, you need to budget about 6 weeks, and you need to be clear on that with the seller, or have a contingency in your contract that automatically extends the closing period. 4, myth. Vice president is a vice president. Vice president is a vice president. So it is a title. Okay. Now you want to work with a bank that there really is a vice president. Now you got senior vice president. It is a title like, executive, account executive, which is a nice way to say salesman, saleswoman. Okay. So you need to go to the website of the bank that you're dealing with and see what everyone's title is and know who you're dealing with. When it says vice president on your business card, you may think that they have the power to make decisions. No, the president, the only person that can do an exception if necessary. And have I done certain things like that? Yes. Now, there's different levels of size bank. I'm just kind of giving you a basic gist here of small banks in general. Vice president is a vice president. That is a myth. Okay. Myth number 5 is bigger is better. No, not the big giant banks are better. I'm telling you right now, I've borrowed a lot of finances over the years, bought and sold houses, refinanced a lot of properties. I would say to the tune of almost 200 transactions or more. Smaller banks do it right. They can usually get things done. It's a face-to-face situation. And I've also seen smaller banks take care of investors that have gone down. Not take care of them, but worked with them when they've been behind or when they have a problem with something. So, bigger is not better. So, here we go. We're going to continue on here on choosing the right bank for your acquisition. Does size matter? Yes. I know that's a man's thing. Does size matter? No, it does. I always go with the small micro bank. Well, how do you gauge that? It's about a $50 million bank in assets up to about a $200 to $250 million bank of assets. Well, how do you know that? Go to their website, check them out, and they usually are proud about their assets. Of course, the people that are in the billions or trillions like Chase or whatever, there's a local bank that's, in the billions. There's a couple of those in Oklahoma. There's several of those, actually 10 of those that are in the billions. Those are the banks, yeah, they can write you loans for real estate, but they're not going to jump for you. They want the $1 million loans. And if you're just starting out trying to get $50,000 deals, $100,000 deals, you want to stick with the $250 million banks and below. And if you don't know how their asset, what they have in assets, ask around. Other bankers know other bankers, and you will find those banks, usually in small towns, usually community banks. Another thing you need to do is know your banker. Google them up, find out where they come from, have a relationship with them, build a relationship with them. Were they a banker before? Why are they a banker? Build a relationship with your banker, know your banker. Even if you don't have a relationship with that banker today, know about that banker. Go call another investor, go to your local real estate club, find out who is doing acquisitions for real estate investors. It's not hard to find it, but you're being lazy. So go out and find your banker. Now, when you find all this information, perform due diligence. What do you mean by due diligence? Just like you buying a house. I do the same thing when I'm trying to get money. I want to find out where they're from. The bank, how long they've been in a bank. How long does it take to close a deal? Who's been burned by the bank? What do you mean by being burned? Meaning they said something and then they didn't close because they weren't happy because of the area that the property was in. You've got to do your due diligence. Are they normally, what type of bank do they like to loan on? What's their bread and butter loan amount? Will they, you got to keep this in mind when you're dealing with a banker. Getting a $30,000 loan for an acquisition is the same work as getting a loan for $150,000. Anything that's over $250,000 is a little bit more work, but it's actually easier. And I know that's just flippant to say that, because it's usually a loan over $250,000 is usually an asset loan based on income, right? They're all based on income, but when you get $250,000 and below, it works on your income to debt ratio, not the actual asset itself. And I know that's complicated, and I threw that one in there. It's not really complicated, but I'm going to break that down some other time. And if you like this podcast about money or whatever, let me know and I'll continue on. This is not a sexy subject. I love this subject. I love not money for myself, but I love what you can do with money as a tool. All right, another thing. So do as much due diligence as you can. Do as much research as you can. Find out everything you can. You should just have this practice on everything you do in life. And the next thing you need to do is get referrals. Go out there and build a relationship with another real estate, like me, your boy, Van Kallenberg. Text me up. Hey, what banks do you have? Come to the landlord lunch. Come to the investor weekend. Connect with people. Don't try to be an investor and then all of a sudden ask people for leads or who's the best banker and you're not contributing. Contribute, give, trade. There's a course that you know about. Tell someone about that course that changed your life, a book. But go buy a book for somebody. Build a relationship and then ask for a referral. So that is choosing the right bank for your acquisitions. All right, we're at 11 minutes. So I'm going to blaze through these other 2 points that I wrote down. You got to compare the banks. So when you're doing an acquisition, and I'll get into this on another time, but real quick, I'll just knock this one out. When you're, like, say you got a big acquisition and you don't want to lose this acquisition, you should probably apply. A lot of people don't know this at 2 banks at the same time, and you want to compare the banks. What's the pros and what's the cons? When can they close? What's the appraisal fee? What's my interest rate? Are they going to work with me? Is it a no money down deal? You've got to compare the 2 banks from each other. Now, don't let them know that you're comparing each other, just like anything else. So just like buying a car, yeah, you could use that technique all the way to the end. Then you whip out your phone and you say, hey, David Stanley down the street has this pickup truck for $2,000, and you're trying, you got it locked down for $2,500. You might get another $500 at the end of the table, okay? And just put another zero on it, $25,000, and you get the picture. So you don't want to pigeonhole yourself and go after one bank. Now, when you're at a certain point in your career in borrowing money, bankers are going to want to hang out with you. They want you to do more deals. That's how they make money. So if you understand how they make money, then you'll understand that they want to loan you money, okay? But, you can't rely on one bank because one bank might have a different vice president one week or a senior vice president or a president, and their culture changes. And I've seen this, one bank was madly in love with commercial money, with apartments, and the next thing you know, it was a credit union. We no longer have a commercial department. Just blasted me, I was basing my business model around borrowing money from this specific institution. So pros and cons, I'll get into that on another time. And then use this information when you close with this competition, this pros and cons for competing. For example, you got one bank that's willing to give you 5.25 on a 20-year AM and a loan, and another bank will give you 5 and 5.5 for a 30-year AM. You got to compare the two, which is the cash flow, but you might want the longer AM and still want the shorter interest rate. You just compare. Hey, bank number 2 is saying this. Can you do that in a nice way? The problem is these bankers, they've got this suit on and this ivory tower, and you're down here in the trenches, and you don't think that you can reply back that you're desperate for the money. No, you got to get educated. You got to understand how the ball is being moved and passed around, where they get their money from the Fed. Banks borrow money from the Fed, and they have to rent that money out to you, and they make the spread, aka arbitrage. So they have to make money. How do they make money? By loaning you money. If you understand the game, they need you as a customer, but you have to put yourself in the light that you are the very best customer and they want to do business with you. Anyway, my name is Stephen Van Kallenberg. Hopefully this is empowering for you. If you have some questions, let me know. Go to the website, savvyradioshow.com. Email me, text me, go on Facebook. I would love to talk more about this subject, but I want to make sure that it's helping you and that you understand what's going on. I heard someone the other day was listening to a podcast and I just said SEO and they didn't know what that meant. So if there's something that I say that you don't understand, you need clarification, I have no problem breaking it down. But ultimately, go buy assets with the bank funding you get.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at SavvyRadioShow.com. Connect on Twitter at LandlordBook and always be buying assets.